Everyone, hello. We are going to officially start the recording. So I want to give everyone a chance to please turn on your videos. We would love to see you. This is a safe space. That's why we make registration as robust as we do, to make sure that you can share freely and we can control the environment. So I'll give everyone a second to turn on their videos so I can see your beautiful faces. Please, hello. We've got 16 people in the room, more joining. I will be letting people into the room as we proceed. I want to start with an intro, and again, we are recording, so please turn on your videos, say hello. I want to just start by saying thank you so much for joining another Onyx Wealth webinar for building generational wealth. This is a super, super important platform that Farallon actually introduced me to with Regina. I'll let them introduce, or Farallon introduce herself, but I'm sure most of you joined us last week. And if you didn't, you can listen to the audio recording, or not last week, I apologize, a few weeks ago, for the session where we highlighted Alethea and Bola. Bola is on right now. I think Alethea is there too. And it was super powerful. I really enjoyed that. I got a lot of positive feedback. And the reason why I think that one was so powerful is because we're starting to tell the story, right? We're starting to tell the story of the things we did right, the things we've done wrong, and helping people on their journey so that they don't just feel like, oh, we've just arrived and we don't want to share the wealth of knowledge that we've been blessed with. So Alethea and Bola were gracious enough to share their story. They're super private people, but they were very, very open. And that was such a blessing to have. So if you do want to see that recording, just let me know, but you can just go to the Jenkins.co or the Jenkins.co website, TheJenkins.co. Zach will drop that into the chat shortly. If you just go to my website, you can see some of the past recordings for that, and this will obviously be on there as well. So today we have Dasarte Yarnway. Hello. And
how's everybody doing?
I'm so excited for you guys to meet him. I want to tell a little story and then I'm going to shut up and let Farallon lead this conversation with Dasarte. But so Alethea and Bola introduced me to Dasarte. When I met Alethea, I remember, not really thinking about financial planner. I had one in the past, but really didn't understand the point of them and what they did. And it just felt like they were giving me something generic that they gave to everyone and nothing was really personalized. And Alethea, if anyone knows her, is the type of person where you just know she's got her finances together and she's been doing it since she was 5 years old. So when she told me one day that she fired her financial planner she had for a really long time and went to Dasarte, I said, okay, well, whatever you did, I need to listen. Didn't ask many questions because, again, if you know Alethea, you know what I mean. And I called Dasarte. And what I was super impressed by was he sat there for probably an hour or so and listened to my husband and I and where we were. This was like 3 or 4 years ago. And what he came back with a week or two later is a super, super robust report on us and everything about us, every single, car we own. We only had, I think, 2 properties at the time, maybe 3, I don't remember. And just, he really dove into spreadsheets and graphs of this is where you are, this is where you want to be. We talked about credit, we talked about savings, we talked about goals. And I had never seen that before. And I think if you ask me now how that has impacted my journey, it created more like an accountability moment of, this is where you're at. You might think you're doing okay financially and all of that and everything looks good, but really you need to pay off that car that's $5,000 and save this amount of money on the interest and move this over here and do that. And putting that on paper from someone who does it all the time and manages like athletes, fortunes and all of that, it really helped us because then we had a roadmap of where we said we wanted to go and how we were going to get there. And he held us accountable to that. So I'm going to stop talking and let Dasarte say hello and introduce himself, but that's why I felt it was super important for you guys to meet him. Dasarte?
Awesome. Well, thank you so much for having me on, NECA. I really appreciate it. I see some familiar faces. Bola, what up? Alethea, what up? And thank you so much for the connection to NECA, because this wouldn't be possible. So I really appreciate it. Calvin's on as well. I see him getting his camera set up. You all are like family. First and foremost, my name is Dasarte Yarnway. I am the managing director of Berknell Financial Group, the founder of Ganta Ventures, which is my newly founded venture capital project that I've been working on lately. and the co-founder of the Onyx Financial Advisor Network, which is a shared name that we had. So we'll
Yes.
talk about that a little later. My reason for starting my firm is simple. Part of it was out of necessity because I believe that many of the people that need financial planning the most don't get it because they don't have these $2 million minimums that are needed at some of the bigger institutions. My journey started after I graduated from University of California, Berkeley, where I was a Division I college football player. Then going to an independent firm, then to a brokerage, then to a bank on Wall Street. At each of these places, I saw that people had the memo that traditionally our communities did not have. They were having conversations at the dinner table that I didn't have as a kid. And I was saying to myself, why is that? Why didn't I learn these things? And I kind of charged myself with the responsibility to take this information from the people that always had it to give to the people that I felt needed it, right? Such as my mom, who came from Liberia, such as many of the people in my community, right? And the clients that I serve today. So the work that we do here, I feel like is super important. I feel like is a calling for me. It's something that I really take pride in. So I'm happy to dive in with Farallon about the nitty gritty, our process, what I've learned along the way, and how I feel like we all can build equity with our respective financial plans. So thank you for having me again.
Awesome. Well, I'll let Farallon introduce herself, but I'm sure most of you have been on these sessions. She is a wealth of knowledge in the financial industry, and I just love how plain she makes it. No apologies, to just let you know that assets are the way to go, and this is why you should acquire them. So Farallon, take it away.
Hi, everyone. Thank you again, Dasarte, for being our honored guest. And I am so thrilled that Bola and Alethea have come back after pouring into our community and sharing their story. That's always really, really positive. For me, I've had a career in finance. I guess at this point, that's now like 14 years old. Mostly focused on markets in Asia, and about 3 years ago, I transitioned to sustainable, responsible, and impact investing. But I work on a financial planning team, and exactly to Dasarte's point, we provide very, very high quality advice and guidance, but alongside a very high minimum.
Mhm.
And he's absolutely right that one of the inverted things about financial services is that the people who have the most money pay the least. The people who have the least money pay the most. And they often get the least services for the higher percentage that they're paying. That said, my commitment to personal finance is out of my own story and kind of my own struggle. I believe that money is for security and opportunity. And so I really believe in sessions like this and empowering people to provide security and opportunity for themselves. It's by no means an issue for me if you decide you want to take your wealth and ball out. That is a choice. That is not where my value set is. And so, really, what I want you to be is to be empowered. And I want you to feel good about your financial position, to feel secure in it, and to feel secure in your ability to provide for all the people that you care for. So, with that in mind, we've asked Dasarte to spend some time with us and to really break down what is financial planning, what it means to examine your financial life, and where we'll be talking about that and the intersection with home buying. So, five, maybe half a dozen sessions, we've been talking about owning real estate. And real estate is an important asset. The key is that it is an asset. If you are going to build wealth, you must convert your income to assets as fast as possible. The goal in building wealth is to have your assets produce the money rather than your work, your labor, or your time. So it is a process. It requires consistency. It does not require perfection. Neither does it require it requires progress. It doesn't require perfection. If you will take consistent steps that compounded over time, you'd be amazed at where you end up. So that's the spiel on converting income to assets as fast as possible. Dasarte, if you were to give your 5-minute pitch about how financial planning builds wealth and the important steps and factors in building a financial plan, what would you tell the folks on this webinar?
5 minutes. Well, I think
Can
that
take more than that, but I'm just trying to
no,
give you that.
it's a conversation for sure. But I would say that financial planning and a financial plan is the compass that sets your feet upon the path towards your financial goals, right? You say that you worked in the industry. I think that the industry doesn't do a good job of giving retail investors, these are individuals like you and I, the compass or the direction to reach those goals. So our industry is simply saying, hey, how much money do you have? Let me invest it for you. And at some point, you'll be able to live in retirement. That is backwards. That doesn't help anybody. And that doesn't necessarily build equity in the different investment vehicles in which you can do so, right? So financial planning, again, the compass that sets your feet upon the path towards your financial goals. How I think or what's encompassed in a financial plan is a couple of different things. We use a mental model at our firm called the rights planning process. So if you're ever thinking about what a financial plan should include, it's in those 5 letters, RIITE. For me, the first R is the traditional thing that you hear in financial planning, which is retirement planning. I think that's evolved exponentially in this day and age. Folks like NECA, right? Retirement planning may look different for her, right? In the sense that she's gathering a bunch of income producing properties that will produce income in her retirement years. That's much different from somebody like my mother, who back in the day was depending on a 401k and pension, right? So that first R is retirement. The next is I, investments. And I say this all the time for people that can't really differentiate the two. The I is for the things that you'll invest in between now and retirement. This is a real estate focused group. Probably many people want to buy more property from now until the point that they say, I don't want to work anymore, right? Or at least a standard 9 to 5. You have to plan for that. You have to do the math for that. The next I is insurance. Our firm doesn't sell insurance at all, but it's something that I believe if you love someone or own something, you should have, right? T is taxes. We all pay Uncle Sam, and it's important to plan for those taxes, right? And to figure out ways in which you can minimize any tax liability. E is estate planning, right? I think it's prudent to think about the people that you love and care for. It's prudent to protect your assets, and just as much as it is in acquiring them, right? So the E estate plan is very, very, very important. Again, my rule for that is if you love somebody or own something, have an estate plan. So for me, financial planning is those 5 things combined and looking at your resources and what you have to set that plan in motion, right? What can we do today that can build that momentum and so compound interest can take effect? That's my perspective on how it should work.
That is fantastic. I noticed in your right method, you don't have a huge focus on income. What are the ways in which you talk to folks about how to use their income in the right method?
But I think that financial planning is a discovery process, right? So your goals are going to be different than NECA's, right? And I'm going to use a NECA because I don't want to use anybody else on the call. But people are going to have different goals. Your lifestyle requires a different level of income than mine. So traditionally, what we use for income is the basis for how we can build your budget, which is going to hopefully factor in what you're saving for the next investment, what you're investing in certain accounts, maybe a SEP IRA, a Roth IRA, which we can get into later on this conversation, right? But that's your today's income, your current income will dictate how we should do your budget. Now, the R in the right planning process, I'm glad you brought it up, deals with future income, right? What you'll need at the moment that you say goodbye to that job or you just don't want to work anymore, right? So that's how we factor in income in both of our, at least today and in the future.
I'm loving this. I actually have just a lot of questions for you. Um, Do you believe that it's
Mhm.
possible for an everyday person with everyday means to build wealth and retire with dignity?
I think it's getting increasingly harder for the everyday person to do that. Okay, and I would be lying to you if I if I said it wasn't, right? But I do think that it's possible for the everyday person to have a financial plan, to see what they can achieve with whatever income level that they do have, right? And I think that was the reason for me starting my firm. One, so I could be a servant leader to others, right? And two, so we can make financial planning more cheaper and more accessible for everybody, because that's been traditionally the barricade from people of different communities getting these services, right? So although it's very, very hard for the everyday person, specifically in California, to kind of build their equity, right, and invest in different things, I do think that these same people, right, can have a financial plan that can help change the trajectory of their families of wealth creation. So I'm a strong believer in that.
When a person has a financial plan,
Hmm.
and we're still going to do the everyday person, so we're going to say the everyday
Let's do it.
person
Hmm.
with the financial plan, what are the things that you would say are required or necessary conditions for that person to be successful?
First of all, it's a mindset. And I think people discount the fact that you have to be in the mind frame of growth, right? Of acquisition, of consistency first before a financial plan even makes sense to you, before it's even going to change your life, right? Because oftentimes what we're creating, what we're taking is just this data that you've provided us with, right? To then give you instructions that we can help you carry out to help reach your financial goals. But this piece of paper, this PowerPoint presentation, this executive summary, whatever you we give to you, won't mean nothing if you're not strongly, if you're not convicted enough to do the things, the day-to-day things that are going to set you apart, that are going to change your circumstance today to next year or 10 years from now, right? So the person has to have the mindset. It helps to have income. It helps to have high income if you can, right? It helps to, again, all of those things, save money in different areas and taxes. But the first thing you have to have is that mindset of growth, of change, of consistency. Without that, a financial plan won't make sense. It's just a piece of paper that anybody can give you.
Caroline, can I touch on one thing just really quick? Don't forget what you were going to say. It'll be fast. I just want to remind people, like, what he just said is so powerful, and hopefully if you're listening to this recording, you can go back and listen to that again, because it applies to pretty much every aspect in life. But that mindset thing is literally what changed our entire lives about 3.5 years ago, almost 4 years ago, when I quit corporate and did this kind of full force and full time. I think that people underestimate the impact that having people in your life to hold you accountable, hearing the story of people that look and you relate to feel confident that you can move forward, and what Dasarte just mentioned about mindset. If you don't change the way you think about wealth, if you don't change the way you think about money, you will be stuck. This is not a just work harder and make more money conversation. This is a how do you view money, and how do you view wealth, and how do you view your ability to attain and maintain a wealthy lifestyle, whatever wealthy means. Guys, this doesn't mean you have to be rich. It means for your standard of living, like Dasarte mentioned, what do you need to sustain? And then what do you need to thrive? And what do you need to live, flex on Instagram, whatever you want to do? What does that mean? What kind of mindset does it take to get there? And are you willing to push through to make that happen? A lot of times we just look for the excuses or invite the excuses. We don't manifest growth. And then we wonder why we stay stuck. So I'm going to shut up. Fairlawn, go ahead. But I just want to touch on that.
No, I'm so glad you spoke, because you said you touched on something that is a tenet I have that I amazingly have never brought up in this current seminar. And so what that is many of us think that our money troubles, our money woes will be solved by adding money. And on a certain level, that makes sense. You think, I'll just pour my money on this and then I won't have these problems. But what I really want everyone to really let permeate your brain, literally, what you do with a little money is exactly what you're going to do with more money. You make those
Precisely.
same decisions on a much bigger scale. So pouring money on poor habits will never transform your life. Even with me, the things that I did that were great with a little money, I still do now with more money. The
Mhm.
things that I struggled with have not ever gotten solved by my income increasing, ever. It has only gotten solved by my behavior changing. And there are still things, about money management that I'm like, oh gosh, why am I still doing that? So I'll give you an example of how I manage myself. Okay. My husband, he's on this call, he's a natural saver. I'm not. I am a spender. But what I have going in my favor is that I'm a planner. And when I was in my early 20s and actually making good money, I would have this repeated monthly phenomenon that I like to call forensic accounting. So it would be this moment where I would suddenly look at my checking account and the balance did not make any sense to me. I didn't know where my money went. And it was like time to turn over the sheets, pull up the covers, look under the cushions. What happened? What did I miss? And kind of inevitably I forgot about a bill, forgot about this or that, and didn't factor that in when I was going out and doing whatever I was doing and didn't have money. So to this day, the way that I manage that is I do not spend money out of my main checking account. There is a separate account that has discretionary money. And believe it or not, I had to learn the hard way. I can't put money in that account once a month because that doesn't work. Not for me. So here I am, 37 years old, and I cannot give myself money once a month. Once a week actually is what works best for me. Every 2 weeks, I have recently found out I can be successful with. But literally, and they're not at the same bank. Now that I have a baby, this is less of a problem. But before that, what I didn't want to be happening is I'm at a bar and I decide I'm gonna buy a round of shots and I just transfer money. That can't work. So literally different banks, literally completely separate accounts. At one point, I was depositing physical checks because I didn't want the connection. But I specifically mentioned this to you as a weakness in how I managed money, and I'm telling you how I solved it. And I just had
Yeah.
to accept, look, this is how I'm successful. Should I beat myself up because I can't, handle a month's worth of money at a time? No, that's a waste of time. I can handle a week. I can handle 2 weeks at this point. Maybe by the time I'm retired, I'll be able to handle 1 month and look at, my discretionary spending in one account and be fine. But that's not where I am right now. So part of being successful with your money is again looking at all the little things you do, whether or not that they're serving your greater plan for your financial future. And if they're not, what are you honestly going to do to stop yourself from those impulses that don't produce the results that you want?
Hmm. I agree. One thing I will say about that, you and Neka hit it on the head. More money will just show you more of who you are, right? And I think that's what people aren't willing to accept, right? Like this is not going to happen. I'm not this type of person. It's just that I don't have money. I want to live my life and I want to do this. But when you get more money, you're just exposed to more of who you are, right? So it's not a income thing, it's a character thing, it's a behavior thing, right? And those are the things that you have to change to have real long-term sustained growth. You mentioned another thing, Fairline, that I thought was very prolific in the sense that you did something called forensic accounting, right? For my clients, I tell them that they need to internalize what their quote unquote budgets are. That's a bad word. That's a B word, right? Nobody wants to get on a budget, right? But they have to internalize it because once you write these things out, right, you're able to really feel what you're spending money on. Like I couldn't believe I spent $10,000 on this, right? I did this on this. So literally, some of the professional athletes I have, I would create them a budget, right? And then they'll go out. And one of the guys just got traded to the Patriots. He bought a Bentley in cash, just like that. I'm like, we got to work on this behavior, right? Like we have to get this right. So um, more money just shows you more of who you are. And that's something that I feel like is a downfall for a lot of young professionals and growing families.
I love that. I think this is the way where this conversation is going is part of why I get I mean, some days I'm so tired and I'm like, oh, Wednesdays are going to be my longest day from 11 a.m. to like 9 p.m. nonstop. And it ends with this webinar, but I'm so passionate. I get so energized by it because I'm trying to create this space where we feel like it's okay to be vulnerable and to be truth tellers, right? So Fairlawn just gave a lot of insight to her personal finances and how she solved for it. This isn't a shaming thing. There's a difference between shaming and accountability. And so often people will hear people that love them in their lives holding them accountable, and they take it as shaming or, oh, what do you know? And look at you, you're doing this. That doesn't matter. Literally, sometimes I think you listen to a divorced person that's been divorced 5 times about marital issues because they've probably gone through a lot of them. Like sometimes the level of advice that you're going to get, you know, instead of personalizing it and taking it personal, try to find the gems in it. You know, does this person, how do they manage their finances? Have they been through stuff? You know, you have to feel like you can be honest about where you're at so that, you know, whoever you choose to get advice from can give you sound advice and you actually listen to it instead of getting offended. Like we can get offended till we're 50 and we can be renting forever because we didn't want to listen to anyone because we didn't want them to think bad about us or whatever. At a certain point, we just have to own where we're at, figure out what works for us, like Fairlawn, the example Fairlawn gave, and employ that, right? So you listen to different people and you figure out a method that works for you. So that's really why I love this space and why I keep it safe and secure. And I want people to chime in and let us know what struggles that they might be having and how they feel convicted in this conversation to make changes. So speaking of that, before Fairlawn goes to the next one, does anyone have any questions, or I'll check the chat. Does anyone have any thoughts, concerns? And FYI, please look at the chat for the link to a couple past sessions. We'll be adding a couple audios, but this one will be the first video. But does anyone have anything they'd like to discuss or comment on?
Well, Dasarte, you talked about the right framework. Is that in order of importance?
No,
letters,
it's not in order of importance.
Where would you get started?
For me, it's about what's a priority to the person. It's not my money, right? So if your priority is investments, that's something that I have to prioritize, right? Because I'm helping you reach your financial goals. But I do believe, holistically speaking, the industry really doesn't focus on all of those things. How can you say that you want to build multi-generational wealth, but don't have a plan to pass the assets down to your children? How can you say that I'm trying to maximize or optimize every dollar, right? But you don't have a tax plan on how you can do that, right? How can you say you want to acquire one income property per year, but you're not making doing the necessary steps, right, to purchase that while still securing your retirement? So it's really about what the individual wants. And we're just trying to use data analytics on all the resources that you have to help you have the most efficient path to get there.
Thank you.
Love that.
Any more questions? We here.
Fairlawn, do you have any other questions you want to lead with, Dasarte?
Yeah, he's a fabulous person to interview. Turning to real estate, in your experience, Dasarte, what are some of the positive roles that you can see real estate playing at different stages of wealth building for somebody who's getting started, someone who's in the middle of the journey, and what, you know, later when we quote arrive, what's the role that real estate plays when we are wealthy?
You know what? This is actually a great question, right? Because there's debate between financial advisors that are quite honestly a little selfish, right? Saying that your home is not a good investment. I don't know if you watch the news or things of that nature. I think is a good investment for the simple fact that it's the only thing that many people will let compound over the next 30 years without touching it. Simply stated, when it comes to investments and like stocks, right? When things start to get volatile or grow exponentially, it's so easy to sell and get get those liquid assets in 1 to 2 business days, right? But a home, it can be much harder depending on where you are, right? And what phase of the market it's in. So as it pertains to a young person, growing family, a house is something that you can transfer to your kids that is going to appreciate and value most times, right? That you can build memories and a life in, right? And if you're younger and you're not ready to settle down, you can potentially get income streams off of that. So I think what I tell my clients is, and I use myself as an example, what I want to create for myself is an ecosystem of different income streams that pour into my multi-generational wealth creation, right? So for me, what that looks like is I'm going to have the traditional assets, the retirement accounts, right? The taxable accounts for my wife and I, different investments. Those are very, very traditional things. I have a VC portfolio in which I've bought equity into 5 companies, right? And then I'm working with NECA and I'm talking to her about real estate all the time. Like, this is what I'm interested in, right? I'm looking to buy this, right? All of these things, just like the right planning process, are a holistic way to ensure that you have one, diversification in your portfolio, right? But you also have these different assets that can multiply from a VC standpoint or a retirement standpoint, can compound and transfer to your kids. So I think that real estate is just another piece of that puzzle that can help with that diversification and that future transfer of wealth.
How does it help with the future transfer of wealth?
Well, for me, I've seen families gift houses to their children through trust, right? So essentially, I just created one of these for myself, and I call myself a servant leader in the industry because, one, I want to help people do this for themselves, but I also want to be an example of how it can be done. To say and speak from experience, like, this is how you do it. This is what I did, right? So essentially, I'll tell you a story. When I was at Fisher Investments in 2013, one of my clients was an original investor in Coca-Cola Company. And the way that he got his 1,000 shares at the time was he was asked to help build the factory. Instead of them paying him in cash, they were like, we'll give you some stock in the company. So old dude, he was like, okay, I need some cash though, right? So he took half of the amount, 1,000 shares at the time, at a very low cost basis or price point, and he took the other 1,000 or so in cash, right? So when he figured out what it was, right? Coca-Cola had appreciated. He looked at it at the account, it was $36 million. He took some of that money, he created a family trust. He bought all these properties, and in the trust, he was able to designate which properties went to which children, right? Many of these properties were on a tax-free basis because he did that in these different trusts, right? So when I say real estate can be something that you gift to your people, using a trust and using other vehicles, you can efficiently help them begin their wealth creation process far ahead of what you might have started with, right? And that's how this thing should be. It should be a place where your kid will never have to endure what you had to get to your point because you did the planning, right? Because you thought about them 20 years ago. So now they're sitting under a tree in the shade, right? And that's what these people, that's what I've learned. That's what I'm trying to implement, right? And that's what I'm trying to essentially gift to my clients as they choose to work with me.
So first, I have to interject here. What you just said, I feel like I should pay you for this session. That is so powerful what you just said. And I want to make sure it's not lost on people that, you know, when he did buy those properties, I don't know this person, but Dasarte, this is more of a conversation, and it's more of a, hey, this is how you still benefit from that, so that people don't just think, okay, so this guy did really well, 36 million, then he bought a bunch of properties, he put his kid's name on it, and then he didn't really get to benefit from any of his hard work, you know, his earnings, until all of a sudden he's dead and his kids have the houses, right? So let's rewind to the in-between place where your investment in those homes that you put your kids' names on, they appreciate, people. And you're able to pull money from it, leverage funds to do something else, whatever. He's still living his best life. Like, yes, I realize it's 36 million, but there's ways that you can live off of that passive income that's coming from those. I'm sure he had renters in those places. Those kids might've been 5 when he put their name on it. They're not living there yet. So recognize that there's a whole path of him living his life and not having to work for anyone, because he's created something so amazing and put it in a safe haven like this trust, that it's going to house it there, so they don't have to worry about, you know, transferring it into, like Calvin and I had to deal with this with one of his parents' properties, transferring it into their name and then having to pay, I don't even know all the terminology, Dasarte can tell you, but you know, the taxes on whatever transfer and all that, or no, we don't want to transfer it because we don't want to trigger this tax and prop this and prop that. right? So there's a whole place in between there of wealth building that he was able to live through. And then at the end, when he's passing that generational wealth on to his children, it's unreal the amount of savings he had in all of those properties, right? So I just wanted to point that out. I think that was powerful.
I think that those are excellent points. I feel like we might have skipped over something and we've assumed people understand a few things. So I just want to
Yeah.
rewind a couple of steps. When Dasarte says you put these assets into a trust, the trust is a legal structure and a legal vehicle. It's considered a legal entity, particularly if it's irrevocable. A revocable trust is one that is in your tax ID and you can change and take the assets back if you want to. Once you permanently gift them, that is called irrevocable, and that trust is its own entity. When that happens, it eliminates a lot of the issues in estate taxes, which is exactly what NECA's talking about. I die, and now when this gets transferred to my children, it either has to step up in the basis to, current value, and they have to pay taxes on that. There's a certain amount of exemption. Or if they sell it, it'll trigger actually at my basis, which could have been, imagine now, 2020 is right around the corner, but maybe when I die, it's 2080. And so, we see houses right now, NECA's helping us look, but we see houses where, the person bought it for $180,000 in 1983. It's currently worth well over $1 million, probably approaching $2 million. Well, you can pay taxes on all of those capital gains, the difference between where it was first acquired and where it ends up sold. So it is not that the trust will not pay taxes. The trust does pay taxes. It pays taxes every year under its own tax ID. What it avoids in many cases is the probate and the much higher level of estate taxation. You will still owe property taxes on any property you own, no matter whose name it's in, or what entity. But there are ways, to Dasarte's point, the T and right. Estate planning helps with a lot of tax mitigation strategies, and it avoids probate. And for those of you who don't realize, probate is actually a public process. Anyone can go down to the courts, find out how assets were distributed. They can get a copy of the will. There are all these folks that are paid in the court system to administer probate. And you could literally find yourself in a situation where the state of California is determining how your family inherits assets. People are being paid, generous fees too, along the way at every court date, every filing. The state takes a cut as well. And as a very personal example, I can give you all, my great aunt had a trust, and for whatever reason, we don't know why, she took her house out of her trust and then died. And that resulted in someone inspecting her will, someone deciding that the codicil she did was not valid. Money literally right now to this day sitting with the state of California, and she died 6 years ago, for two people that we have not been able to find or locate. It is an open question as to what the state will do after 10 years have passed, or whenever it is you can legally declare someone dead. We don't know. And all of this happened for the bargain price of $63,000 behind the sale of her house. That would and by the way, she was one of those people who bought her house in whatever that town is next to El Cerrito for $58,000 in 1960 something. And we don't know. We literally don't know. And if she had kept it in the trust, one of my cousins would have been the executor. All of issues would have been followed. And that's not the way that it went. And most of us work way too hard. And I don't know, as progressive as I am, I don't know government to be the people who make the best decisions. I certainly wouldn't want them choosing what to do with my money. So the trust structure is very favorable, I guess, to holding real estate assets. assets actually, and allows you to avoid estate taxes. Does that make sense? Does anyone have any questions?
That makes a lot of sense. And just to chime in, I think that financial planning is for today and tomorrow. It's for now and later, right? I think that a lot of people think when you talk about things like a trust, right? You're only thinking about that period of time in which you're no longer here to be around your family. But there's so much that you can do right now that you can really do and enjoy and watch the growth, right? And be able to spend it down. That's that I that I talk about, that in between time and investments, right? An investment in your family, going on trips, buying things that might make your life better, right? And then everything after the trust, the estate planning, right? Being able to eliminate some of the future costs of an estate, right? By filing for a trust. And that's why I think financial planning is so important because it alleviates the money issues or stressors out of the equation. So you can just live your best life.
Absolutely agree. I wanted to touch on just something to tie it back to when you were giving your list of things, and the last one was estate planning. I want to tie that to this probate conversation, right?
Mm-hmm.
In short, they explained it really, really well. But in short, I want to just make clear that while you're still alive and the wealth building that you're doing, if you do not plan accordingly for the what if that could happen, which means you dying tomorrow, we don't know when our time is up. If you don't do proper estate planning, the government, the courts will decide what happens with your property, because it's not written down somewhere that your husband, your mother, your sister, or whatever should take control of that should anything happen to you. So that's what triggers this probate conversation. In short, I had a client, we put an offer on a place, he got the offer accepted. It was probate. We understood what probate meant. The type of probate this house was needed court confirmation. Okay. That meant that when his offer was accepted, 6 weeks or 8 weeks or COVID time, 3 months later, he's still waiting to close on the home. He's got the money. He had to put 10% up front. They didn't care. Cashier's check, not playing around, not wiring it to whatever. You got a cashier's check, bring it to the courthouse. 3 months later, I have to show up with him at the courthouse. None of the family of the house that he wanted to buy was present, but some random person who claimed they were family, let me make that clear, claimed they were family, whether they were or not does not matter. They came to that court confirmation, and at the point at which they're about to say, yes, the person that won the bid, my client, you get the home that you purchased 3 months, that you tried to purchase 3 months ago, got an accepted offer from the executor of the trust. Oh, sorry, there's someone that contests it. So we've got to drag this whole thing out or give it to him. He got the chance to bid. At that time, it was like $5,000 over what my guy did. They don't give him another chance. They go back and forth a little bit. It's up to the judge. It could be $5,000, it could be $20,000, whatever. The point is that you're going into this process and there's so many unknowns, because when you go to court, this judge gets to say, oh no, somebody contests it, so we have to drag this out again. So imagine if you're the sister of the owner of whatever, and somebody else gets to buy your house, the court gets to dictate, then they say, bid it up, bid it up, bid it up. You should get that property outright. Like Farallon said, they get to charge all this money and bid up this price when you should just get that property. But because the owner of the home, your sister, your husband, your wife, did not do proper estate planning, you end up, if you really want to get that house that belongs to you, you end up paying more for it. And you have to bid against it to somebody else on the open market. So that's just one example. There's many examples of how probates can go wrong and this, that, and the other, especially when they need court confirmation. But that's the E that he talked about, which is estate planning. You should not be only concerned with that when you are 75 and retired and whatever. You need to be concerned with it now. As you're wealth building, you need a financial plan and you need to worry about estate planning. It doesn't mean you have to have 10 properties. It means you just need to make sure that everything you own goes to where you want it to go. Dasarte, if I said anything wrong, please just correct me.
Simply stated, my rule for estate planning, people often say, do I need this right now, right? If you love somebody, if you own something, if you plan on owning something, get an estate plan. Get an estate plan. You'll thank yourself for it. As you acquire property, you'll put it right in that trust. All these things will be taken care of for you. So again, if you love someone, own something, plan on owning something, get that estate plan done.
This is good. I think that we've covered actually an incredible amount of ground. I'd like to open things back up to everyone here. If there's anyone who has a question that you'd like to ask, let's jump in.
Yeah, Dasarte, what are some common either misconceptions or mistakes that people make early on when thinking about building wealth?
One of the biggest misconceptions is I don't have enough to begin building wealth. And I think that wherever you are, start. That's the first thing. I was actually looking at the JenkinsCo.co today, and I looked at your little principles that you had on there. And one of the first things that NECA had on there was start. And I think that's it. Whether that monthly or biweekly contribution is $50, or in some cases for some of my clients, $50,000, right? What you're doing is you're sowing a seed that somebody will be able to harvest, or even yourself, in the distant future, right? And I think it's super important to just get started. That's one of the biggest misconceptions that I see all the time. And this is with people that have money, right? Like, I don't have enough. And I think that's just brainwashing of the financial industry and who they said these vehicles, right, and this process was for. But I don't think that has to be true.
I wanted to jump in on that and add on to that. Yes, that's the first thing to do is get started wherever you're at, and that doesn't have to be with money. NECA and I, she mentioned earlier that a big growth for her was when she got out from corporate and went into real estate full time. In reality, I think the growth for us started way before that. And when we were in a 2-bedroom master apartment and we didn't have money to invest, but we sacrificed our comfort, and we rented out one room and we stayed in the other room. So you don't always have to start with money. You can start with sacrifices to get you started, and those sacrifices will turn into money.
Mm-hmm. That's a really good point. I think you mentioned, Dasarte, you mentioned like contributing to your wealth building and just starting that. It's also like creating that habit, right? Like once you start, like you mentioned, once you just start and you push forward, you're creating a habit, you're flexing a muscle that you're going to need continuously in this process. And I think that's super important because you have to get used to getting uncomfortable, like Calvin mentioned, right? So we got uncomfortable with how we lived. It was before we had our babies. And so we got uncomfortable with how we lived to maximize on income coming in while we were renting. So in this situation, it's like, get uncomfortable and call someone and talk to them about your finances and be real about it, so that you can then have a roadmap to where you want to go, and you can start creating a new habit for yourself. You're going to find that when you do little steps like that you're not used to doing, you're going to manifest different things in your life. You're going to look at things differently. Like Farallon mentioned, you might not be as free with your money, right? You might create boundaries for yourself. Then all of a sudden you're saving money. All of a sudden there's an extra $100 in your account that usually you're living paycheck to paycheck. When you shift that mindset, when you create different habits, when you're on that journey, things change. The people you talk to change, people you listen to, the people you surround yourself with, what you feed your mind with. So I think all of that is super critical.
I agree. All wealth building moves don't necessarily have to be like centered around money, right?
Mm-hmm.
What I know to be true through working in the industry for some time now is that the people that think counterintuitively are those who build the most wealth, right? So what you did was sacrifice your comfort, right? Which is a counterintuitive thing to do, and sowed that seed for a future or delayed gratification. And that's the nature of investing. That's investing one-on-one, right? Make a move, wait, right? Let it compound and watch the investment or that quote unquote sacrifice mature into its proper figures. You guys did it in a textbook fashion.
Two things just came to me listening to you guys talk. The first is that a part of the conversation around wealth building is always going to involve sacrifice, because to build wealth, you have to defer. some current gratification. If you spend every dollar that is coming in on your current needs, there is nothing to sow into the future. So, by definition, building wealth is creating room between what you're spending on current needs and what is available to sow into the future. The next thing is that what Dasarte was touching on, I think Warren Buffett is famous for saying that markets are incredible mechanisms for transferring wealth from the impatient to the patient. And what that means is the person who stays in the race, who waits it out, it actually takes out a lot of the genius that is required. Persistence and time, if you can make that work in your favor, you actually don't have to be very smart. Patience goes a long way to building wealth. And then the third principle, when you want to talk about, I guess, quote unquote, being smart, is that often you need to think differently and be right. Don't think differently and be wrong. That's not a formula for success. So, I mean, you can come up with a lot of flavor and ways to go out here and do something ridiculous and be wrong. And if you do everything the exact same way that everyone else does, you'll have exactly what everyone else has. So you must be different and right. And that's not as difficult as it seems as long as you are willing to be patient. One thing that hurts me, Dasarte, is you and I are kind of insiders on the financial industry. We've been talking around some of these things. And what I wanted to give you some time to talk to our audience about is why don't you kind of walk everyone through some of the different models of how people get financial advice and like how they're charged maybe because there's some distinct models out there in terms of how financial advisors earn money or how people who say that they're giving financial advice are compensated and all have I'll say this, some models are just inherently better than others, I will say that, but it's always important when you're thinking about um, having someone help you or what you're looking at that you understand how people get paid and whether or not that's aligned with your future.
Yep. I just want to make a
Right.
comment
So why
before
don't
we
you
kind of,
talk through some of the basic models so people know um, what
yeah.
to.
I want to make a comment about everything you said. I thought those were phenomenal points, right? In terms of the Warren Buffett quote, one of my favorites, and Benjamin Graham, which I really love. They're kind of, Warren Buffett is a descendant of Benjamin Graham. And I really kind of like live by those principles that they've gifted our industry with over the last, it seems like 100 years, right? But what I wanted to touch on is that wealth building doesn't have to be complicated. And I think that in this day and age where information is circulating super fast and it's changing hands and inboxes, we try to complicate it with the latest trend or fad, right? And it does not have to be the case. There are ways to build wealth seemingly hiding in plain sight, right? Like leveraging your employer benefits. Wealth just isn't money, it's also health, like health benefits, your 401k and a 50% or 100% match, right? Looking at opportunities to invest in the businesses of your friends or family. Certain things help generate wealth, and I've seen it happen time and time again when a $20,000 or $10,000 investment turns into 2 million, right? So there are opportunities to build wealth in plain sight, and it does not have to be complicated. And I think that we complicate it a lot in this time. To your point there, or to your question, there's so many different ways that financial advisors charge. When I got into the industry, the ways that the firms that I worked with charged were on a percentage-based fee. So they would charge a fee as high as 2% for the most complicated hedge funds, all the way down to 25 basis points, which is a quarter of a percent. Simply stated, how that works is if a person has, let's keep the math simple, $100 in an account, and an advisor charged a 1% fee per year, they would charge that client $1 per year, right? And probably break it up into 4 payments of 25 cents a quarter. That's one of the ways that people, advisors may charge. Another way that an advisor, which is really an insurance agent, might charge is through the commission of a product that he or she might sell. right? So on a life insurance policy that they sell you, they would receive a commission of anywhere from 3 to 6% of that policy on the sale, right? So you hear jokes all the time about people being car salesmen or insurance salesmen. The reason that they're selling so hard is because they get a commission on selling you whatever product that they're trying to sell, right? That you may or may not need. So that's another way to receive compensation. Recently, the industry has shifted because people want fiduciaries. People don't want to be sold. They want to be taught on how to be better with their money. So it has shifted towards a kind of retainer and subscription model in which independent advisors will charge a flat fee for the services or attach a flat fee plus a percentage basis points on the investments. What that looks like is an advisor might say, hey, I'll do your investment management, your financial planning, your taxes, your estate planning for $3,000 a year, right? And you'll pay that advisor on a monthly basis or quarterly basis, right? For those services. He might also say, $3,000 is my fee for all of these financial planning things. You can do it right here in house, and I'll charge you 25 basis points to manage your investments. So those are the most three popular ways that I'm seeing. I think that the industry is continually being disrupted through technology and easier way to do things. So fees are getting what we call compressed, right, and cheaper across the board. But I would say again, percentage-based fees, commission sales for certain advisors, whether that's on different products like A-share mutual funds, insurance policies, right? And then you have the subscription model or the hybrid subscription model, which gives you a flat fee plus an investment management fee.
Okay. So let's break those down.
Yep.
I'm gonna go in a different order. Let's do the commission based.
Mm-hmm.
So when someone earns a commission off of your investment, I want you this is what I mean by thinking about the alignment. Someone earns a commission off of your investment, they're paid when you make an investment. When you buy it, and also when you sell it. Insurance products people tend to buy and hold, but like if we're talking about a stock or bond, they're making a commission per trade. So their incentive is probably to bring you ideas and to keep you trading so that you are paying them. That's their cost. In the annual percentage model, the advisor's paid an ongoing fee. They are usually not at all like if you see you're paying a fee and you're also paying for trading. I think that might probably is illegal, but you shouldn't be paying for any trading or any of that. You may have to pay like whatever if they're using like a manager or like a hedge fund. You may have to pay that person's fee in addition, but that's not something the advisor gets. And how does the advisor make more money? In an asset-based percentage fee, they only make more money if they make you money. And they actually will make fewer dollars if they lose you money. So like in a bear market, when your assets are going down, so is your fee in dollar terms, even if the percentage is still the same, right? But costs are a very real part of eating at compounding across time. So they do have to deliver value in excess of what they're charging you. And then the third model, the hybrid model, I think, which Dasarte says is like, okay, a flat fee, and then maybe even a small asset-based fee. It's like a hybrid. I've even actually seen advisors who, they have packages. They also say like a lawyer or an accountant, you can just pay me for my time, and here's my hourly rate. You pick. But they essentially put on a cap more like many other like professional capacities, where it's not about the assets under management. It's about them actually being compensated a rate for their service.
Mhm.
And in that case, in that third case, if you're paying the advisor for your plan and it is a flat fee or is a fee for their time, that advisor is probably going to be agnostic to the investments. Those investments will really be, or the plan will actually really be tailored to you. And their business is mostly going to be built around not holding assets in house, but in you being satisfied and you continue to tell other people about the work that you received, similar to that's how a lawyer's practices. No lawyer has it. Lawyers may have some clients that are constantly paying money, but in general, many lawyers who are independent, they are earning fees by, word of mouth and by additional people coming through that door who also want their service. So that's important to kind of understand and to decide which model you think fits where you are in life, and to understand that from the perspective of the advice. This is also touching on why Dasarte said this conflict around real estate exists in our industry. It's because it doesn't serve an advisor if you have money locked up in a house. In most cases, they're paid if that money is at their firm, either, going in trades and earning commissions or in an asset-based fee. It is also incredibly important to think about whether or not that person is a fiduciary. And you can actually ask them, are you a fiduciary? And if you are a fiduciary, you are legally required, read you can be sued, to put your client's interests above your own, above your firm's, and you act in their absolute best interest. The current standard in financial services is suitable. So as long as the investment I give you is suitable, it doesn't have to be in your best interest. I can sell you the one that gets me the highest commission as long as it's suitable. Doesn't have to be the best one. Doesn't have to be the one that I think absolutely meets your needs in the best way. These are like very important, I think, concepts for you to think about. And in general, the type of guidance that Dasarte is talking about, that tactical compass plan, do this, do that. This is the path that leads you to your financial goals. That tends to come from the independent financial advisor offering their service for a flat fee or a fixed rate. Does that make sense?
Yeah, I think something you both kind of touched on is, well, I think Dasarte mentioned it. AI, artificial intelligence, is taking over a lot of industries. It's trying to take over real estate. It's, I'm sure, trying to, take over with financial planning. And where I've seen that personally is one of my nephews works at Charles Schwab. And I remember thinking, okay, that's my nephew, let me support, right? But that's a huge company. And what I found is the advice they're giving is very, very boilerplate. It's like the same packet they're sending to everyone. So to break down what Farallon and Dasarte are kind of saying is, when you feel like there's not a personal touch on the level of service that you want, you have to make a decision if that cheaper fee, you might think it's cheaper, right? But like she mentioned, it depends on how they're charging you. So do you really know how much you're paying over time in the different kind of investments you're doing? And you really have to decide, do I want a personal touch? Do I want a human that actually cares about what my goals are? Because if they're only, one lane focus, like Dasarte mentioned, he's not going to September, to Farallon, to NECA, to Calvin with the same plan. He's paying attention, what do they need, where are they at, and what are their needs in that specific city and state that they're in, and what applies to them, so that he can make it a specialized, a personalized plan for them. I think that's super important. And I find that as much as AI is trying to threaten that, even in real estate, I find that people that truly see the value in the service part of this aspect tend to win, right? They're not just going for the cheapest, but they're also not just going for someone who's going to give them boilerplate because they're a big name like Charles Schwab. So I like the personal touch. It's important to me, and it's proven very successful for our personal and professional life.
A robo advisor is not going to give you advice when the market's in a
No,
bear market. A robo
no. A
algorithm,
robot
or
advisor, yeah, no.
it's not going to tell you if you should sell this house, if you're thinking about it, or if you should buy this house. It's not going to walk you through the process of doing so, right? So I'm on that same team, NECA, but it's important to know how things are paid, right? And how advisors get paid. That's going to ultimately help you make the decision and figure out what service is best for your needs. As Fairlawn said, I think that was an excellent breakdown of the different types of compensation models.
Absolutely, I agree. Does anyone have any questions? Erica, I see you there. Thanks for joining us. TK, I'm sorry, I'm not sure what your full name is, but TK, Alethea, Melvin, Daniel. Oh, somebody's on. Hey, September. Brianna's on. September, did you have oh, she just looks like she's having issues. Hey, Erica and family. Kofi, hi. Daniel, Krista, good to see you. Rosalind, hey. Monique, Christina, Maddie. Anyone have any questions for Dasarte or in general? Everyone wants to be shy. Caroline, did you have any additional questions?
Dasarte, can you give us some actions people can take out of this call?
Actions that people can take out of this call. I think you gave the best action, actually. Create a home base for how you can do forensic accounting. I think that our values, right, and our money personalities are built into what we spend our money on a month to month, quarter to quarter basis, right? So if you look at July is about to end next week, right? Look at that next bank statement, right? Go through it line by line, right? And try to figure out what did you need to spend money on? What were fixed costs that you had to spend money on to sustain your lifestyle? And what were variable costs, things that you chose to spend money on? And let's see where you end up, right? I think that's the first action. And I think that it's okay to get help with your goals, whether that's buying a house, speaking to an advisor to put it together for you. Consider those things because it makes the world of difference. I'm a testament of that from NECA and just from the mentors and the people that I ask on a daily basis. And I think it's something that everybody can benefit from.
I'm going to translate his answer to contact Dasarte. I think you need to see how robust his financial plan is and have even an initial consultation and understand how beneficial it is to look at your finances in a different way. The forensic accounting that Farallon mentioned, rewind this tape and listen to it. If that's something, just like Dasarte just mentioned, that you have to really just sit down with yourself, with your partner, with your family and say, what am I doing here? And comb through that, it will be probably a rude awakening, and just take that as, hey, now I see it, now I can change it.
Dasarte, what are some things that you typically recommend to help people hold themselves accountable to the financial behaviors that they want to have?
One, I'm going to go back to the forensic accounting. Two, get a partner. Get a partner that you can openly discuss money with, right? Somebody you can say, hey, these are my goals. These are yours, just like you would if you were trying to do like a lifting or gym challenge, right? Get somebody you can talk to about money. Share those goals. Speak to them. Be open about your mistakes. Be open about your successes. And hold each other accountable. I think that's the best way to do it because you don't have to do it alone. A lot of times advisors are looked on to kind of fill that space, but we're here to implement, be a sounding board, fill the knowledge gap, but it helps to have somebody that you trust in the fight with you.
I have one word of caution about that, though.
What's that word?
I know folks who, so when he says find an accountability partner, he means a real one. He doesn't mean your girlfriend when you say like, oh, I want to lose 15 pounds and she's the person you like going to happy hour with. And the two of you are going to be like, do we really want to go to the spin class? Or can we just skip it and go to Starbucks and we'll just tell each other how we tried? That's not the accountability partner you want. So if you find yourself in this kind of, accountability conversation and both of you are enabling each other, you need a new partner.
Mm-hmm.
And I love that. I really, really love that. And also, this is for me, maybe it's a little too harsh, but if your accountability partner does not make you feel uncomfortable at one time or another, maybe at least once a week, you need a new one. If no one's making you feel uncomfortable, if life isn't making you feel uncomfortable, you will not grow, period. Okay. It's not about being offended. It's about, like she said, finding the right one and letting them offend you and move and press forward.
Hey, I have a question.
Hey.
This is Olivia. Hello.
Hey, girl.
So, Dasarte, just a quick question for you. Good to see you.
Good to see you.
What's the minimum would I need to get started to start investing with you?
Traditionally, advisors have super high minimums. At our firm, there is no minimum because we're one of the advisors that charge a flat fee now. And we've always been a no minimum firm. So there is no minimum to work with Berknell Financial.
Let me just make it clear. I was damn near
Now,
broke
just
when
for
we
fun and
started
giggles,
working with them.
ask me what the minimum is for my team.
Yes. What's the minimum, Caroline?
$5 million.
And she's with a big company,
Yeah.
y'all.
And 70% of our assets are private family foundations and operating nonprofit, but then the high net worth families that come along with that. I say that to say, literally, this industry is not built to accommodate the everyman building wealth. So when you find someone who's built their business model on helping everyday people be successful, try it out. Because one of the things I can guarantee you is that bringing, to us, it would seem like a lot of money, but bringing $100,000 to a big firm like a Merrill, a Bank of America, a Morgan Stanley, a Goldman, it honestly gets you no service. I wish it were different. I wish I could tell you something else. It pretty much is going to get you a robo advisor.
It's
And if
disturbing.
you think about it, I don't know what Dasarte's fees or anything are, but one of the examples he gave was $3,000. If you think about it, I am sure many of us, me included, are very capable of wasting $3,000. Very capable. Many of you, it could be in less than a year. It might not even take you a year to waste $3,000. That's just to say that it really does benefit you to get a financial plan, to get the guidance, and the guidance helps accelerate your development and your progress. It's just that simple. And I say this as literally no skin in the game.
No, it's so true. If you look at your net worth or what you're doing right now, and when you start looking at things the right way and analyzing them and look at your net worth there's no way it's not going to be higher. So money well spent. Dasarte, do you have any final words you'd like to share with our community? Words of advice, encouragement?
My big thing for me, I've been focused on is being intentional. This year was my year to be intentional, right? Everything that I do, anything that I put my hands on, I wanted to be intentional on it. How was it bringing me peace? How was it eliminating any baggage or trauma, right? How was it pouring into the vision that I created or I want to create for my life? And I think that when you take that approach, right, everything becomes an investment, right? Going to the gym becomes an investment in your health, right? Spending times with your family becomes an investment in the memories that you'll hold forever. Putting money in the account becomes a future investment that your family will be able to reap the rewards with. So, one, be intentional. Make sure that you're doing that. This conversation was an intentional way for us to talk about money, right? And how we can utilize this information to build generational wealth. And then number two, we talked about mindset, and I know that's something that you've been very keen on since I've met you, NECA, right? If you set your mind on a definite path, watch the world make space for you. So continue to work on your mindset and watch things unfold. I'm super excited to see what everybody in this group does with the information from this conversation. And I really appreciate you and Fairline having me on to be a part of the conversation.
I noticed that someone dropped your podcast link into our chat window. Do you want to give us a quick elevator pitch for Young Money?
Yeah, Young Money actually is my old podcast. We have a new one now, but Young Money and both. So I do a couple of things.
Yes.
I'm an avid blogger. So you can go to berknell.com to see all the stuff that we have coming out on the blog. Specifically, we'll be writing about people that get paid in equity, right? So a lot of us know that San Francisco, Silicon Valley has all of the tech companies there. We write a lot of content for people that get paid in equity. So you'll be able to subscribe to Young Money, which has all the content on fundamental financial planning and interesting topics. I said that Young Money was the place where money and motivation meet. So you'll be able to be inspired and learn something about your financial plan as well. Pay Me in Equity talks about all things equity, equity from an equity compensation standpoint, from building your own equity through business ownership and more. You can subscribe to that at Pay Me in Equity. I have 3 books. The latest, Pay Me in Equity. Young Money was a book as well. That Bola and Alethea actually threw the book launch party for in Oakland. And the first book that was self-published, Amazon Top 100, Dating Benji, Straight Talk on Improving Your Relationship with Money. So the content is there. Feel free to subscribe or look it up, read the book, listen to the podcast. And you can find me on Twitter. That's the only social media I'm on now. So
What? You left
my name.
Instagram for Twitter? Ugh.
Yeah, man. at Dasarte Yarnway on Twitter.
Okay. Yeah, we're gonna put your blog on the chat. Yeah, we just put it on the chat. We put your email on there, cell phone on there. I just want to stress what he just mentioned. He has 3 books, you guys. I need you guys to at least get one of them and read up on it. He has a wealth of knowledge. If you've been paying attention on this webinar, he's had at least 6 or 7 different moments that I'm going to go back and quote him on. So I hope you paid attention to this and took heed to the advice from Farallon and Dasarte. They come from 2 different worlds in the financial industry. Of course, Dasarte runs his own firm and is able to, give back to the community in a way that I think is unique. Farallon works for a company where the minimum, did you say, is 5 million to use their services?
The minimum for my team. Yeah.
For your team. Yeah. So, replay this entire webinar. Please let us know if you have any questions. We will have this on the website to everyone, the video and the audio. And if no one has additional questions, I'm going to let you go off to your family. But I am so blessed by this community. I really enjoy it. Dasarte, I really appreciate you. Ever since you referred me to the Delta Foundation and introduced me to Farallon and that first event I did, I think everything that's happened since then could go in a book. It's just been super inspiring to watch this community grow and all the connections and just be around such great minds. So thank you. Farallon, any final words and we'll let them go?
Well, I will frankly, since we're speaking honestly and intimately, I will say that I am very nervous. Many of you did not show your faces and I did not hear a question. So that often makes me think that you are listening, maybe with or without intentions of acting. And so what I would say is don't lose the energy or the excitement that maybe this conversation stimulated for you. And I just need you to do one thing. It does not need to be a big or a dramatic thing. It needs to be one thing. That one thing could be that you email yourself something you are going to do for your finances as a to-do list before you go to bed tonight. That one thing could be, okay, yes, I know I need to be tracking my finances, so I'm going to put that on a calendar. Or I'm going to go sign up for, an annoying, app like Mint, where I'm going to tag every last one of my expenses for a month. And there's nothing like doing that to make you want to stop spending money because you just are really not excited about having a tag, and realize how many transactions you rack up. So I just want to encourage each of you. I hope you are encouraged. I hope that you have learned something. And even if you didn't learn anything, I hope in the time that you've been here with us, some thought occurred to you of what you could do to improve your financial future and have healthier financial habits. And whatever that thing is, do it. It is not thoughts that get rewarded. It is the actions. Thoughts can produce actions, but it's the actions that lead to the outcomes. So that's that. Dasarte, thank you for being here. Would you like to close our audience out?
Again, thank you so much for having me here. Nneka, you're amazing. Calvin, you're amazing. I appreciate you putting on this platform for us to all get together, be open, be vulnerable, and learn. And I look forward to the next one.
Yay! Thank you so much, guys. Everyone have a good night.
You too.
Thank you.
Take care.